Welcome to this explainer. Look, as Chief Gold Strategist at Alpha Trader Fund, my objective today isn't to just sit here and summarize charts for you. We are integrating the macro data, the bond market, and multi-timeframe technicals to build a unified, institutional trading thesis for gold for the week ahead. So let's get right to it.
First things first, as a macro strategist, literally the only question that matters for our trading desk right now is this: are we buying or selling XAU/USD this coming week? We never start with a history lesson here, right? We start with actionable direction.
So here's the bottom line. Our primary bias for the week is mildly bullish. We're looking for a buy entry specifically if the 4-hour market structure holds inside our demand zone. That's between 33.52 and 33.65. Unless the macro environment just violently shifts on us, we are actively avoiding sell setups. Now let me walk you through exactly why we're positioned this way, and it all starts with the foundation of all macro moves, the bond market.
All right, synthesizing the why. When we look at institutional positioning for the 10-year Treasury note, we're seeing a steeper decline in the 10-year price compared to the 2-year. Now, what does this tell me? It indicates a bear steepening of the yield curve. Institutional hedge funds are heavily positioned for higher long-term yields right now. But when we dig a little deeper into the net positioning across the entire curve, something vital jumps out. Leverage funds are actually reducing their shorts on the short end of the curve, while asset managers, they're holding heavy longs across the board. This basically means the market expects a gradual easing cycle without some massive hawkish repricing. And because rates aren't being priced to just surge higher, real yields are staying relatively stable. That is huge because it removes a massive traditional headwind for gold.
However, it's not a completely clear runaway for us. Shifting over to the US dollar index, institutional speculators have aggressively expanded their net long positions. This massive influx of systematic buying of the greenback is a glaring short-term bullish signal for the dollar.
And honestly, this perfectly illustrates the tug-of-war happening in the markets right now. We've got rising US dollar longs creating this heavy overhead barrier for gold, and they're fighting against the underlying support of stable real yields. This exact dynamic is why our desk is in a mildly bullish environment rather than an aggressively bullish one. That dollar strength is keeping a lid on things and preventing an unbridled breakout for the precious metal.
Okay, let's move over to the metal itself. Looking internally at gold's institutional positioning, managed money, the hedge funds and commodity pools, they remain heavily net long. We're talking about a massive 8.5-to-1 ratio of longs to shorts. They are firmly in the driver's seat, pushing this market higher.
But crucially, the week-over-week change tells a much more nuanced story. While they are still heavily net long, the sharp drop-off in new longs signals that aggressive speculative buying has temporarily paused. Meanwhile, swap dealers, the guys taking the opposite side to provide liquidity, they're just maintaining their large net short. So what this positioning tells me is that we're in a pause and consolidate phase, not a distribution phase. The institutional players are basically just holding their ground and catching their breath.
Now, what's really fascinating here is the broader context where this consolidation is playing out. If we look at the one-week asset performance matrix, it reveals the true underlying risk regime of the market right now. Just notice the top of the board. The commodity complex is showing some serious, undeniable strength. We have crude oil surging almost 10%, with silver right on its heels up over 4.5%. Meanwhile, all the way down at the bottom, the VIX, the market's ultimate fear gauge, is sinking by over 4.5%. This overarching risk-on sentiment, combined with immense commodity strength, puts a massive tailwind behind our mildly bullish gold thesis. Gold is sitting very comfortably in positive territory within a super healthy asset class right now.
So zooming out to the weekly technicals to align our macro data with price action, the higher time frame structure remains firmly intact. As you can see, the long-term uptrend hasn't been violated at all. And this completely validates those underlying managed money long positions we were just talking about. The big money absolutely has not abandoned the trend.
By juxtaposing the daily corrective structure with the 4-hour time frame, we start to see a really clear transition. On the daily, we're moving out of a markdown phase and into some localized base building. Then on the 4-hour, those higher lows are carving out very specific institutional footprints, forming a beautiful bullish order block. Drilling right into those footprints, the recent change of character, which signals a clear shift in momentum, above the 3380 level is what gives us our statistical edge. Based on this market structure, we're assigning a solid 65% probability of an upward continuation test next week. And that target? It's the overhead daily supply zone at 3480.
But hold on, before we just blindly execute a trade based on technicals and past positioning, we absolutely have to account for event risk. Looking at the economic calendar for the upcoming week, it starts off relatively quiet, which is honestly great for our technical levels to play out. However, there is a massive volatility catalyst looming on Thursday that we simply cannot ignore.
Thursday's FOMC rate decision and press conference is the ultimate macro driver for this week. While the rate is widely expected to stay at 3.75%, as we all know in this game, Jerome Powell's tone at the podium has the absolute power to either validate our bullish setup or completely blow it up by sparking a massive US dollar rally. So how exactly do we trade this? Well, here is the institutional execution plan to navigate this specific confluence of technical structure and intense event risk. Remember, we don't chase the market, we patiently let the market come to our predefined levels of liquidity.
Our primary scenario triggers a buy only on a pullback inside that 4-hour bullish order block, right between 33.52 and 33.65. Your stop loss needs to be strict here. A 4-hour candle close below this order block means the thesis is dead and we cut the trade, no exceptions. But if it holds, our take profit target is that daily supply zone sitting up at 34.80.
Alternatively, beyond normal market fluctuations, we always have to be prepared for the extreme bearish tail risk. Our high-risk 15% probability scenario triggers only if a surprisingly hawkish FOMC spikes the US dollar and completely shatters daily demand down at 33.10. If that structure breaks with real momentum, it opens a short target significantly lower to the 38.50 to 3900 range. But remember, we only trade this on a definitive structure break with confirmation.
Because of that binary event risk on Thursday, proper portfolio management is non-negotiable. To protect your capital, you need to cut your standard position size by 40 to 50% heading into the FOMC release. Please, do not try to be a hero during the immediate algorithmic chop of the news. Stay flat, stay out of the market during that initial spike, and only resize your positions once the market's true directional reaction is clear.
All right, bringing this all together. To summarize everything we've synthesized today, our baseline confidence sits at a solid 65% for a mildly bullish continuation. This is heavily supported by managed money longs, a stable yield curve, and some really robust commodity strength, provided of course that the Fed doesn't deliver a hawkish shock to the system.
The macro data and institutional positioning beautifully align for higher prices, but the final verdict rests entirely on Thursday. Will Chairman Powell's tone shatter our 4-hour order block, or will it act as the exact rocket fuel gold needs for that next aggressive leg up? Manage your risk, stick to your levels, and let the market show its hand. If this institutional breakdown brought you some value today, make sure to share this explainer with your trading desk. Trade safe, and we'll see you in the next one.